Welcome to Samba Samba. Enjoy the video.
In this video, I will explain how to use the morning star candlestick pattern. This powerful three-candle formation often appears at the bottom of a downtrend, signaling a potential bullish reversal. It indicates that sellers are losing control and buyers are beginning to step in, suggesting a shift in market sentiment. Understanding this pattern can help you identify potential turning points in price action. The morning star pattern consists of three distinct candles. The first is a long red or black candle, confirming the existing downtrend. The second candle is small, often a doji or spinning top, showing indecision and a potential pause in selling. This small candle typically gaps down from the first. The third candle is a long green or white candle, closing significantly above the midpoint of the first candle, indicating strong buying interest. To effectively identify a morning star, first ensure there's a well-established downtrend. The second candle, the star, should ideally gap down from the first candle's close, showing a clear shift in momentum. Strong confirmation comes with increased trading volume on the third bullish candle, indicating significant buying interest. The third candle should also close above the midpoint of the first bearish candle, reinforcing the bullish reversal signal. When trading the morning star, a common strategy is to enter a long position after the third bullish candle closes, confirming the reversal. To manage risk, place a stop-loss order just below the low of the second, small-bodied candle. This helps limit potential losses if the pattern fails. Profit targets can be set at previous resistance levels or by using a favorable risk-to-reward ratio, such as 1:2 or 1:3.
Thanks for watching. Consider subscribing if we helped you.